Welcome to The Explainer. Today, we're talking about something huge. The way we build wealth has completely changed. The financial advice our parents got, it's being seriously challenged. And it's because, let's be honest, we're facing economic hurdles they just never had to think about. All right, let's kick things off with a real bombshell. You know that age-old advice? Just save your money in a bank account? Well, some of the smartest financial minds out there are now saying that's a guaranteed way to lose your wealth. Yeah. You heard that right. And the big one, the cornerstone of the old dream, buying a house, that's getting torn apart too. So if all the classic rules are broken, what are the new ones? What are we supposed to do now? So what's really going on here? At the heart of it is this concept, currency debasement. It just means the value of our money is dropping day by day. Think about it. When more money gets printed, each dollar or pound or euro you have buys a little bit less. It means the price of the big stuff like stocks and houses is just skyrocketing way faster than most of our salaries can keep up. And this isn't just some abstract theory. The impact is real, and honestly, it's pretty staggering. Get this, back in 1950, more than half of all 30-year-olds were married and owned a home. Fast forward to today, that number has crashed to just 12%. It's just, the old path isn't really an option for so many people anymore. So in response to this completely new reality, three really different financial philosophies have popped up. Let's meet the key players in this modern money debate, because they each have a pretty different idea for how we're supposed to navigate this new world. Okay, so let's break these down. First up, you've got what we can call the diversified traditionalist. And this is the camp of someone like Jaspreet Singh. His whole philosophy is about patience. Spread your bets across stocks, real estate, gold. The goal is to minimize risk. Then you've got the complete opposite, the high-risk futurist, championed by folks like Raoul Paul. He basically argues the old system is so broken that the only logical move is to go all in on high-risk, high-growth stuff like crypto. And then kind of bridging that gap, you have the pragmatic hybrid, like Humphrey Yang. His whole deal is, hey, build a safe foundation first with things like index funds, and then you can take some calculated risks with a smaller part of your money. See? 3 totally different maps for a brand new financial world. All right, this is where the biggest clash of ideas really happens. It's in the world of investing. And the central debate, it's simple, but it's profound. Do you play it safe and build wealth slowly over decades? Or do you go for broke and try to close that wealth gap fast? So on one side, you've got the S&P 500, the reliable, steady engine of the American economy. And on the other side, you've got something like Bitcoin, a super high-octane asset that, let's be real, has created insane wealth. But it comes with the kind of volatility that will keep you up at night. And when you actually look at the average annual returns, wow, the difference is just staggering. The potential gains from crypto have historically just dwarfed traditional markets like the NASDAQ and the S&P 500. We're talking about the kind of speed that could, in theory, close a wealth gap in a few years, not a few decades. But, as we all know, those huge returns, they're only ever half the story. And yup, here's the other side of that shiny coin. The price you pay for those insane returns is the risk of massive, absolutely gut-wrenching drops. To get those 145% average gains, you have to be willing to watch your investment drop by 70% and not sell. That psychological battle is where most people tap out. It's one thing to see these numbers on a chart, but it's a totally different thing to live through it. But the argument for taking on that crazy risk, it's a powerful one. For a whole generation that feels like they have so little to lose, taking these huge bets might just be the only logical path they see to closing that ever-widening wealth gap. Okay, let's shift gears to the next big financial decision we all face, where you live. For decades, we've been told a home is our greatest investment. But is it really an asset, or could it actually be a financial liability in disguise? Right, the traditional thinking is that renting is just throwing money away. But the modern argument turns that on its head. It says that buying a home actually traps a huge amount of your capital in a low-return, hard-to-sell asset, and that prevents you from putting that money to work somewhere else where it could grow much faster. And this isn't just some fringe theory. It's a real, growing trend. The number of millionaires who are choosing to rent has actually tripled in just the last few years. They're making a conscious choice to prioritize financial flexibility and having cash on hand over the idea of ownership. Okay, so we've seen all these fiery debates, crypto versus stocks, buying versus renting. But what's really interesting is that underneath it all, there are some fundamental principles that all three of these experts agree on. Like, these are the things that are completely non-negotiable for building wealth, no matter what path you take. So here's the crucial point. It doesn't matter which path you end up choosing, the traditionalist, the futurist, or the hybrid. These 3 steps are the absolute foundation. You can't skip the basics. Let's start with step 1. And here's a pretty wild statistic for you. 65% of Americans have no idea what they spent their money on last month. Think about that. It's literally impossible to get ahead financially if you don't even have a map of where you're starting from. Now on to step 2, and this is something everyone agrees on. Your single greatest financial asset is your ability to earn more money. Seriously, investing in yourself, learning new skills, becoming an expert in something, that often gives you a way higher return than any stock or any crypto coin ever could. And for step 3, building a system, this is all about taking your emotions out of the driver's seat. A really powerful tool for this is something called dollar cost averaging. It just means you invest the same amount of money on a regular schedule no matter what the price is doing. It automates your investing, and here's the cool part, it makes sure you're buying more when prices are low. And this just proves the point perfectly. It's a bit morbid, but the best performing brokerage accounts, they often belong to people who have passed away. And why? Because they don't do anything. They're not panic selling or making emotional trades. They just have a system and they let it work. It shows that sometimes the smartest move is to get out of your own way. So, after hearing all of this clash of ideas, the old rules versus the new, safety versus speed, what are you supposed to do with all this information? How do you actually apply it to your own life? You know, the key takeaway here isn't about picking one single winner from this debate. It's about understanding that the entire landscape has shifted. You need to know the very real trade-offs that come with each of these modern paths. The game has truly fundamentally changed. At the end of the day, personal finance is exactly that. It's personal. The old financial roadmap is gone. So the most important question is, what are you going to draw on your map? Thanks for joining me for this explainer.